BingX, a trusted global crypto exchange. Trade spot, futures, or copy top traders easily. Sign up via the link or referral code to get 30 USDT instantly, plus up to 1,500 USDT in bonuses for verification, deposit, and trading.
A significant generational transformation is underway in the property investment landscape of England and Wales, with millennials now constituting a remarkable half of all new buy-to-let investors. This seismic shift, revealed by an incisive report, signals a profound change in the demographic profile of landlords, even as rental yields experience a gentle dip. The findings are particularly striking given the widely acknowledged financial hurdles many millennials, individuals born between 1981 and 1996, have faced in aspiring to homeownership. Traditionally, this cohort has been less likely than older generations to possess their own property, making their current surge into the buy-to-let market all the more noteworthy. Despite these challenges, evidence suggests a segment of this generation has not only navigated but thrived, spearheading the charge into property investment. This analysis, drawing from companies' house data meticulously compiled by the esteemed estate agent Hamptons, underscores the growing influence of younger investors. For the first time in recorded history, millennials have comprised a full 50% of all new shareholders in buy-to-let companies established thus far in the current year. This represents a significant increase from just 5 years ago, when their share stood at 40%. Looking further back, the trend becomes even more pronounced. Over the past decade, the proportion of shareholders in newly formed buy-to-let entities who are under the age of 50 has climbed from 68% to a commanding 3/4 this year. While the property market has seen some established landlords divest their portfolios in response to increased taxation and a more stringent regulatory environment, the vigorous influx of these younger investors has been instrumental in sustaining the overall volume of landlord purchases. Crucially, the proportion of homes acquired by landlords across England and Wales has remained remarkably stable year on year, defying expectations and the impact of an elevated second home stamp duty surcharge. As of April, landlords now contend with a 5% surcharge, an increase from the previous 3%. Despite this additional financial pressure, landlords collectively accounted for 11.3% of all property purchases in the third quarter, a marginal but significant uptick from 11.2% recorded during the same period last year. Hamptons projects that millennial landlords will be instrumental in the establishment of an impressive 33,395 new buy-to-let companies this year alone. This figure more than doubles the number of companies incorporated in 2020, highlighting the accelerating pace of this generational investment. These burgeoning investment activities are increasingly decentralizing, moving away from the traditional property hotspots of the south of England. In a telling divergence from past trends, the combined regions of London, the southeast, southwest, and east of England accounted for only 34% of all investor purchases across England and Wales in the July to September quarter. This stands in stark contrast to 2016, when these southern regions represented a dominant 50% of all such transactions. Investors are now actively seeking opportunities in the north of England, drawn by the allure of higher rental yields and the cost-effectiveness of cheaper properties, which consequently reduces the overall burden of stamp duty. The northeast of England, in particular, has seen a substantial landlord presence, with over a quarter, precisely 28.4%, of homes sold in the region being purchased by landlords, a figure that dwarfs the 8% recorded in London. This shift in investment focus is occurring against a backdrop of a slight cooling in the rental market. The average rent for newly let properties across Britain experienced a modest decline of 0.3% in the year leading up to September. This translates to a decrease of £4 per month, with the average rent falling from £1,402 to £1,398, according to Hamptons. This marks a discernible departure from the robust 4.2% annual rental growth observed just a year prior. The deceleration in rental prices is largely attributable to London, where monthly rents have fallen by a more pronounced 2.7%, or £65. Within Inner London, the decline has been even more significant, with rents decreasing by 4.6%, bringing the average down to £2,766 per month, a figure that is now £165 below the peak recorded in October 2024. However, it is crucial to note that rents for renewed tenancy agreements continue to exhibit upward momentum, consistently outpacing inflation. These renewed contracts have seen a 4.6% increase in rental costs over the past 12 months. The broader economic implications of this generational shift are profound. Buy-to-let businesses have now ascended to become the single largest type of business entity within the United Kingdom this year, significantly outnumbering fast food takeaways or hairdressers by a factor of nearly 4. This phenomenon reflects a broader generational transition, as baby boomers, now in their 60s and 70s, are less inclined to establish new property investment portfolios. Instead, their focus is increasingly shifting towards winding down existing holdings or facilitating their transfer to the younger generation. In a particularly telling development, the number of companies newly incorporated and led by